Bitcoin doing 70% drawdowns every couple years, I think is probably a thing of the past. And I think it's only to be expected because of that structural change in the market, not just the market size and surpassing 2 trillion in market cap, but all the financial instruments that are now at play within the Bitcoin market, whether it's options on IBIT, the ETFs themselves, the futures contracts, the micro futures contracts, the derivative desks, the fact that, banks and brokers feel more comfortable interacting with this in a way that they didn't in the past, where they might have gotten yelled at by their boss or even fired if they were, holding crypto assets.
Looking at historical cycles, Bitcoin's tendency for frequent 70% corrections might be a thing of the past. In broader equity markets, such corrections are rare, happen only during catastrophic events like the Great Financial Crisis or the dot-com bust, whereas 20-25% corrections are more common and often serve as healthy resets. Bitcoin's volatility, with corrections every few years exceeding 50%, may be tapering off because of structural changes, increased size, liquidity, and sophisticated financial instruments.
Bitcoin has hit 0 of the 30 as of 2 days ago when I looked. Do you think that Bitcoin could have some sort of market correction or bear market as it's kind of been following this 4-year cycle without having had the blow off top? Like, I kind of think of the institutional participation, it used to be this kind of huge blow off top. You get a market correction, you get this like very deep sell off, and then you kind of go up and do it again. What we've seen since the ETFs is actually more of kind of like a 45-degree grind up in price, right? And it seems like we're not getting too far ahead of ourselves, but also the drawdowns have been much shallower as well. Could that just be a market structure change? Now you have a different, kind of bid in the market. And so people should kind of throw out this idea of expecting blow off tops, but also expecting these, deep kind of 70% drawdowns.
Yeah, I do think so. I'm not saying that, Bitcoin's never going to draw down 70% again. It's always possible. It's possible on the S&P 500 as well. But when you look at like a 50% drawdown in broad equity markets or even the gold market, they're pretty rare. They're pretty few and far between, right? So 20%, a lot more common, 25 maybe. But, we had a 50% drawdown in the Great Financial Crisis. We had more than 50% in the NASDAQ after the dot-com boom. That's twice in the last quarter century that's happened. Bitcoin doing 70% drawdowns every couple years, I think is probably a thing of the past. And I think it's only to be expected because of that structural change in the market, not just the market size and surpassing 2 trillion in market cap, but all the financial instruments that are now at play within the Bitcoin market, whether it's options on IBIT, the ETFs themselves, the futures contracts, the micro futures contracts, the derivative desks, the fact that, banks and brokers feel more comfortable interacting with this in a way that they didn't in the past, where they might have gotten yelled at by their boss or even fired if they were, holding crypto assets. So I think a lot of these things, they put in, I wouldn't say a floor, but they're volatility dampeners. And that's not to say, Bitcoin doesn't have volatility. I talked about the huge up moves we've seen this year, 25% in 3 weeks, 15% in 6 days. So it's still got volatility, that's for sure, but it's definitely less. And I think, this move, could we break down? Yeah, I mean, I think we could. You have to admit that that's always possible. But I'm just not seeing a really good story for someone to tell me why Bitcoin should go back to 50,000. I just don't see why that's what makes sense from here. In fact, when I look at the broader big time macro issues, sovereign debt bubbles around the world, money printing. I mean, you literally had the Fed saying they're restarting expansion of the balance sheet. Now, it's probably only going to be commensurate with, nominal GDP growth. But that's still a big deal to say, oh, we're going to stop selling treasuries or stop letting them roll off, and we're actually going to start buying them. These are the types of things that are the core of the debasement trade. And I just don't see them either ending the narrative for Bitcoin or ending the narrative for gold, which, we haven't talked about yet. But again, I see that as just bouncing around, consolidating at this point. Could we go a little bit lower? Sure. But we're already getting close. That rising 50-day moving average is coming up quickly. And so, I think gold might have a little bit more downside and definitely more time to consolidate before another breakout occurs. But I don't see gold, going back to 3,000 or silver going back to 20, or I just don't see these things as likely. But they are probably possible. But they're, like I said, 10, 15% outlier chances in my book.
How does that play into your analysis as you think through both stocks, Bitcoin and gold?
It's generally bullish because I think we are doing things that are deemed necessary from a national defense, American sovereignty perspective. And I actually don't think that would or will change with perhaps someone on the other side of the aisle in the White House, in 3 years from now. I think that these are necessary things that actually you could call it the blob, the foreign policy elites are also in agreement with. And basically what they've recognized is, look, we essentially are no longer a self-sufficient country when it comes to certain things, whether it's chips or rare earths. And even if it's not profitable for these companies to go out and mine in the U.S. or, do fabs in Arizona, we have to support them to do that. And these are things that are not uncommon. These are things that the United States has done time and time again when it's deemed it necessary. It happened after the revolution when we wanted to break away more from British dependence on textiles, and we started building the textile mills in the United States and the Industrial Revolution. It happened during World War II. There was a famous example during World War II where the head of Montgomery Ward had basically refused to kind of break a strike, and they were involved in different war production. And FDR sent the National Guard into his corporate headquarters, and they carried him out in his big boardroom chair. And there's this famous picture of the CEO, chairman of the board of Montgomery Ward, being carried out of his office, and the entire company was put under direct control of the Department of War, and it was called the Department of War back then. And so, these types of things, they happen, but they've tended to happen, maybe when there's an actual physical war going on, but there isn't that hot war with China where the bombs are going across the Taiwan Strait. But we're on a semi-quasi-war footing with them from a foreign policy perspective. And I think that's here to last. And I think it's going to take time to get our sovereignty back in some of these key areas. But I think that's the plan and the agenda. And so Washington, White House Asset Management, Inc., I think is going to be in business for some time.
The infusion of derivatives, such as options and futures, has likely created a volatility dampening effect. Banks and brokers, once hesitant about crypto assets, are now more engaged, feeling more comfortable managing risk. These factors act as implicit hedges and cushions, reducing the likelihood of catastrophic downturns.
A massive breakdown, a technical breakdown in the uptrend that gets confirmed. So we drop dramatically below this 98 level out of the channel, and we stay there for a week, and we can't get back into the channel. Then I start to say something's going on here. I might not be in the news, but the price is telling you something that you have to pay attention to. The other thing would be, as of pretty much all year, while there have been some vocal people on the left against, digital asset regulation, for the most part, the Genius Act was bipartisan, and a lot of the scuttlebutt around the Clarity Act, which is the digital asset bill that's going to kind of define what's a commodity, what's a security, how's it going to be regulated, what kind of entities these need to be. All of those things have relatively been bipartisan. If that would to start to fall apart and it looked like any regulatory progress is kind of stalled out and there's not going to be any more, that would be a concerning thing to me. And then, of course, there's I don't know if you call them black swans, because if you can identify them, they're not really black swans, but, some super secret Chinese quantum military computer gets discovered that threatens encryption, but that's going to be a big problem for the whole world, for every bank account, for militaries. I mean, so there's always something like that out there, but I mean, that I put it at extremely low likelihood. And I think the other two, the first two, probably 10-15% likelihoods tops. And so you've got this, predominantly positive backdrop with the charts telling you we could very well be at a low. And, in the past, those have been opportunities to take some risk. Yeah, I mean, we were making, new highs last week, and we just weren't seeing a lot of the stocks, just the pure number of stocks, kind of following along and saying, hey, we're buying into this, all over the place, across all sectors, that sort of thing. And so one way to look at that is percentage of stocks above their 50-day moving average. It was, peaking out over 50% last week, and then it kind of precipitously dropped off. And as you said, it was at 39% as of the close yesterday. So you'd like to see that over 50. You start getting below 50, and a move to like the 20-day moving average is no big deal. But we've had a number of stocks that are basically gone in their own bear markets that are down 20-30%. And so, again, I'm seeing that as healthy, because a lot of those stocks that are the froth stocks that have been up, 200% this year, 500% in the last 2 years. And so to see them come in 20-25% is a healthy thing. But when you do start seeing that, and then you have the algorithms that play off of these types of moves, selling can beget selling. You've had this sentiment. You had the Michael Berry disclosure of NVIDIA and Palantir puts. So you've had this sentiment creep in that, hey, we could be getting toppy, valuations extended. Meta had a very poor reaction to their earnings when they basically expanded their CapEx. So you have to be fair, right? You have to admit when there are negative things out there, you need to recognize them. And I think that's one reason why, cutting back on exposure when you get a very euphoric run like we saw last week, where we were just shooting up every day, it makes sense to say, hey, let me pull some cash in, so that if we do go down in the coming days or weeks, there's money there to put back in at lower prices. So I think that's what's going on. And I think that overall, these type of technical indicators like breadth and things can get worked through. And I'm sure that if we keep up doing what we're doing today as we record on Wednesday, with a strong day in the markets, a strong day for Bitcoin off of the lows that we hit overnight, a lot of these technical things get worked out, and maybe by the end of the week we're back to 50% of companies around their 50-day average. If not this week, then next week. So I think these things can get worked off, and then we have this positive seasonality out there that I don't think can be ignored. People talk about portfolio managers needing to chase to keep up with their benchmarks. You look at basically past years when the market's been up 15% at the end of October, what happens in November, December. And so to have a little brief pause in the action, everybody catch their breath, all that stuff that I think is happening, I think the key thing is to remain calm and not get all panicky and say, oh my gosh, I've got good profits, I need to sell everything now and book those. Nobody gets hurt taking some profits once in a while, but to also keep in mind there's a lot of positive things on the horizon, and that the volatility is a feature, not a bug of high uptrend markets. As we talked about last time, all the big pullbacks in the NASDAQ during the dot-com boom. And I think we're going to see a lot more 1% days in the market in 2026, and we're going to see a lot more $5,000-$6,000 candles in Bitcoin, and that's just going to become par for the course. And it's kind of one of those markets. If you can't take the heat, maybe get out of the kitchen. But I think there's going to be volatility. That's for sure.
Looking at historical cycles, Bitcoin's tendency for frequent 70% corrections might be a thing of the past. In broader equity markets, such corrections are rare, happen only during catastrophic events like the Great Financial Crisis or the dot-com bust, whereas 20-25% corrections are more common and often serve as healthy resets. Bitcoin's volatility, with corrections every few years exceeding 50%, may be tapering off because of structural changes, increased size, liquidity, and sophisticated financial instruments.